Hello and welcome to Portfolio Matters, weekly markets checklist, week 199. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What's happening this week, Keith?
Thank you, Richard. First of all, the news. So, 2 weeks worth of news. Trump met Xi in South Korea, and a 12 out of 10 meeting, according to him, in which they announced a sort of truce in the tariff war without coming to any sort of formal agreement. The export restrictions on Chinese rare earth metals will be deferred for another year. US will cut fentanyl-related tariffs on China by 10%, which I'm told will bring the overall rate down to 47% from 57%. But I notice none of the tariff trackers have actually lowered their tariff rates on China yet. The Fed met. It cut interest rates by 25 basis points to a range of 3.75 to 4%. But Jerome Powell gave a hawkish speech in which he said that the further cut in December was not a certainty. Markets are pricing in a 66% chance currently that the Fed will cut in December. There were two dissents. The Trump appointee, Stephen Mirren, voted for a 50 basis point cut. Kansas City Fed President Jeffrey Schmidt had favored no cut at all due to ongoing inflation and inflation expectations. Well, sorry, Truflation has US inflation rising at the moment. Obviously, the government shutdown means there are no official data currently. The Bank of England met. It held rates at 4% in a split decision. But the voting was 5-4, with 5 in favour of a hold and 4 in favour of a cut. Bank of England Governor Andrew Bailey expects interest rates to settle around 3.5% in the medium term. I continue to think that is way too high. We'll take you through the latest data. The ECB met and held rates at 2.15%. Inflation is stable and close to target. The economy is steady, so expect not much change from the ECB in the coming months. Overnight, the Director General and the head of news of the BBC resigned over alleged manipulation of video showing Trump inciting the Capitol Hill riots. And also overnight, 8 Democrats crossed the aisle to vote in favor of a budget compromise which would allow the US government to reopen. The Senate now needs to debate and vote on that bill. So, the odds on the US government shutdown coming to an end soon have risen sharply. In markets, equities had a volatile couple of weeks with the Nasdaq ending down 2.7%, but Asian markets had a good day, and the potential reopening of the US government has improved the mood. Oil has drifted lower, Brent 64, WTI 60. US natural gas rose very sharply, up 34% over the past couple of weeks. Industrial commodities were generally indifferent. Precious metal bull market looks like it's restarting after a pause. Gold back over 4,000, silver up very strongly. Richard will be happy. Some charts relating to the news. Well, this is the latest probabilities for US rate cuts. They're putting a 67% chance the Fed cuts again in December, but then no expectations that they will cut again until Q2 next year, and interest rates will settle around 3 to 3.25%. But US inflation is rising. Now, Trump had a bad couple of weeks politically. There was a mayoral election in New York, which the Democrat Zohran Mamdani, who's quite socialist, won, but elsewhere the Democrats won on high turnouts. Governor in Virginia, with Democrat won with 57%, New Jersey again 57%, and the turnouts were high. Are we past peak Trump? And now this was the odds of a US government shutdown as of midday yesterday. So 36% chance that the government shutdown would end by the 15th. This morning, 94%. So markets think that the Democrats crossing the aisle will bring an end to the US government shutdown, which means we'll get some data slowly. And each week the US government has shut down, and remember, it's been a record long US shutdown. It has cost the US money. Now, the US GDP is about 30 trillion, so these are not huge numbers, but it has had an impact. Nvidia had a bad week, but a couple of weeks, but it's just put it back where it was a month ago. We have a whole section coming up on the AI bubble and how to play it. Thank you in advance to Simon W. for his contribution. Correction. Last week we stated that Bulgaria will be joining the the EU, on the 1st of January 2026. Actually, it's already a member of the EU. It'll be joining the Eurozone on the 1st of January 2026. Thank you to Discord member PHS for pointing that out. And on to equities, Richard.
Okay, so over the last 2 weeks, I think there's been a lot of noise, but not a huge amount of movement, probably. So the FTSE All World was down 1.9%. The All Share was virtually unchanged. Stocks Europe was down 2%. S&P 500 down 2%. The Russell actually down a bit more, 3.5%. Nasdaq down 2.7%. But as Keith says, if you just draw a line to the Nasdaq price chart, it's well above the ascending line. So it's just a bit volatile at the moment. And Hang Seng up 1.4%, Topics up 0.9%. A fairly bad week for Bitcoin, down nearly 7%. And the pound down 1.6% against the dollar, euro 0.9% against the dollar index up a little bit at 1%. And
I've forgotten about VIX. I'll fix it in the edit.
Yeah. So this is the FTSE All World. It's a very nice straight line since channel rise since May.
Yep.
The FTSE All Share effectively pretty much the same thing. And the Euro stocks, S&P 500. A lot of noise, and Nasdaq Composite. A lot of noise last week, but basically it's a bit so what-ish.
Yeah.
Russell 2000, is it rolling over?
Well, I thought this was quite interesting, actually. So this is the chart over 1 year. And I hadn't realized it's actually down over the course of 1 year.
Yeah.
So
very slightly down. Yeah.
Yeah. It's up 9.1% year to date. But obviously it had a bad December last year, November, December.
There's the Hang Seng. I mean, everything is basically ploughed on upwards since the sort of the tariff tantrums.
Yeah.
And there's Topics. Just doing very nicely. Bitcoin. I mean, I think Bitcoin is very volatile. And if you actually look at a linear chart, it can drop massively from here and still not break its uptrend.
Yeah. It's still, massively up from its lows in April.
There's the pound, which is rolling over a little bit at the moment.
Yeah, I mean, the thing is, I expect sterling to drift lower over the next year because inflation is coming down. Interest rates are therefore coming down. We're going to have fiscal tightening, which means that the economy is going to weaken, and that will tend to lower interest rates. Well, essentially, if you tighten fiscally, then the only two ways of stimulating the economy are to reduce interest rates and lower the exchange rate. And I expect both to happen, basically.
Another point, I think, is that I think the US is going from strength to strength, actually. And
Right.
I don't see the US dollar. I know Trump has a low dollar policy, but I don't see the US dollar falling because their
Right.
economy is so strong.
Okay.
But I do see commodity prices going up. So I think the sort of recent mantra that commodities are inversely proportional to the strength of the US dollar is probably going to break down, or actually is currently breaking down.
Right.
So there's a euro against the US dollar, basically looks the same as a pound, rolling over gently. And we have the dollar index. Yeah, so there we have the VIX, which is up a little bit to 19. Here is the fear and greed index. I'm not quite sure actually how the fear greed index is measured, calculated.
Yeah, it's extremely volatile, I'd say.
Yeah,
I'm skeptical. I think
I
it's
mean,
probably
it seems to me there's two sorts of fear, Keith. There's a fear that, oh God, I bought these shares at the top and they're down 10%. And
yeah,
there's a sort of grinding fear of I bought these shares and they're down 75%. And
yeah,
we might be in the former, but we're certainly not in the latter. And you would have said the latter should be we're
yeah,
going to go down 75%. So it just doesn't seem to see, as you say, it's very volatile. And I don't know. It's almost a contrarian indicator, isn't it?
yeah, yeah. Well, I question whether it's got much value at all, frankly.
Yeah. Median value of stock market investments in holdings by individuals. I'm not sure really.
Well, look at that. The wealth effect. Basically, the median value of US consumers' stock market investments has doubled over the past year. Now that is having a huge wealth effect in the US.
How can it have doubled over the last year? Because the
Well,
markets haven't doubled.
no, they haven't, but people may have moved cash into them, and
So if this is, I mean, we know margin's gone up.
yeah,
So maybe it's the gross value, not deducting margin debt.
I don't know. Well, it's self-reported, Richard. So
Yeah.
it could be lots of if they start off with zero allocation to equities and then they pile in, it
Mm.
doesn't mean the market's gone up. It means their allocation to equities has gone up. So,
Yeah.
but still, rising market, very good for US consumers.
Yeah. There we are, margin debt following the market up and is at a record high. What is it as a percentage, I wonder?
Yeah, the thing is,
Valuation.
as we've talked about before, a lot of this is very highly correlated with the market itself.
Mm.
So it's not necessarily that concerning.
I mean, there's a couple of points on it generally, aren't there? So over the years, not us, me,
Yeah,
other commentators have continually been saying the US market is overvalued and it's going to
yeah,
fall substantially, and it
me.
doesn't, and it isn't, as it were.
Yeah,
And I sort of, maybe this is a good. Everyone should start shorting when I say this, but I think that the US market isn't going to fall particularly. I think it will be protected by the government because it is so integral now to the economic success of the
mm,
US, and
well,
it's not going to be permitted to fall, and they'll just pump money into it to make sure it doesn't, effectively inflating the economy.
yeah. I mean, I think it's very difficult to maintain markets because they're um, subject to volume. If punters decide to sell, it's impossible to stop. Keep the market up. You know, say you think about 1929. It's like there's um, there's the weight of money from US consumers will overwhelm any attempt to keep the market up. But we'll see. Obviously, I've been totally wrong about the US market. The
Yeah,
valuation
the
has
only thing I'd
kept on
say
going
on
high.
on, on your that comment there, Keith, is that if you don't let it drop more than 1 or 2% by
Yeah.
continually goosing it a bit,
Mm.
then punters don't get scared out.
Yeah, but ultimately there's a weight of money. If you can't keep it like rising indefinitely, getting valuations getting higher and higher.
So what I'd say is none of us can tell the future.
No.
I don't bet on it dropping anyway. I've sort of sidelined what the US market does in my mind as an irrelevance,
Yeah.
because I don't think it's not rational in some senses, and I think it is manipulated. So
Mm.
I sort of push it to one side and think, well, it'll do what it will do. I don't think it's going to crash, and then get on with my
Yeah.
investment theses.
Well, you have clearly been right, and I've been terribly wrong, Richard. So,
Yeah. Doesn't mean
um,
I'll continue to be right, mind you, Keith.
well,
And you could
going
say I've been
forward,
lucky as well. I think it's a.
yeah, but I mean, I think last week we did an oil market special, and going forward, I'm going to yeah, go back to like core skill base basically, and just play the oil market. And
Mm.
so, um, because the thing is, over the weekend, I've came to the realization that the game I thought I was playing, which has turned out to be very bad. Basically, trying to play the economic cycle, but there are just too many variables. And in this case, I've been caught out by, just an extraordinary difficult cycle. But actually, the game you're playing is much easier. Just like find a secular trend and sit on it. And
Yeah.
so the in the oil market, I think that you're going to get a secular trend now, but it's a
Yeah.
question of timing this particular cycle in the next few years before you jump in. And
So
then,
what I. Sorry, Keith.
and so at the end of this podcast, we're going to be talking about my disastrous portfolio and what I intend to do. But the reality is that the tax changes in the UK mean that outside your SIP on your ISA, you basically have to be very careful about jumping in and out. And so I think going forward, you don't want to be holding necessarily individual stocks. What you want to be holding is a fund which does the rebalancing for you and just hold it forever, basically. So I'm probably intending to move into an oil ETF slowly and just hold it. And
Mm.
yeah, that's it. Not
Interesting. Yeah.
rebalance. And I spiv around in my SIP and my ISA, but not in the main portfolio.
That is a very interesting point, Keith, actually, which hadn't occurred to me at all.
Yeah.
Uh,
24%, mate, and likely to go up.
yeah, and as you say, if you let the trading happen in a effectively non-taxable vehicle, which is
Yeah.
what ETF is, then you benefit from, if you pick the right ETF, you benefit from that rotation without. Okay, very, very interesting thought indeed. So, but we'll talk about it a bit at the end, because there's a few things I'd like
Yeah.
to say about the commodity cycle actually at the end,
Sure.
and I'll
Okay.
probably best put that in at the end, isn't it?
Yeah.
Okie dokie. So this is a chart that shows that investors are remaining bullish, record bullish since, well, very bullish.
Yeah.
And the S&P 500 versus active manager equity exposure, which is basically they move in lockstep pretty much.
Yeah, but it's above 100. So active managers are net long, leveraged long equities. Amazing.
People are basically, probably not deliberately, but they're inadvertently following a momentum strategy, which is what investing in the Mag 7, etc., is.
Mm.
And it is a strategy that has worked very well over the last few years. The Buffett indicator, which is the US market cap versus GDP, actually, it's not quite at all-time high, is it? It's not quite as high as it was in
No.
2021.
Yeah. But that's because GDP collapsed.
Yeah, yeah, that's a good point. Because it's inverse, isn't it?
Yeah.
And Michael Berry is shorting everything that he can find in tech, I think, isn't he?
Yeah.
And he may well be right, but I think timing on this is just extraordinarily difficult. And it's certainly not a game I'd like to play.
Well, last time it was about 2 years too early. He was eventually right, but it
Yeah.
hurt.
They nearly bankrupted him, but he made it through. Clever guy.
Yeah.
I think it's a very dangerous game to play.
Yeah. Shorting, terrible.
Yeah. Q3 earnings have been very good, which is one of the reasons I think that the US is not going to go into recession.
Right. Well, the thing is, Richard, I think the US, this is a sign that the US economy is increasingly unbalanced. That essentially, when you look at who's making money, profit margins are increasing, wages are growing very slowly, the labor market's doing badly. US economy is falling into a fallacy of composition.
Mm. You may well be right, Keith. I mean,
Yeah.
in fact, you probably are right. You think about these things more deeply than I do.
Well, I mean, Richard, the irony of the last few years is I think about this a lot, and I've completely and totally fucked it up. And it's like the of all the people who watch this, I probably have the worst performance. So you're kind of standing back and like thinking about things strategically has absolutely trumped my thinking about things, cyclically, which I've completely messed it up. So
Mm. Mm. Yeah, I mean, I think it is possible to. I think it. Yeah, I think it's a very tricky balance. Actually, I really do think it's very difficult to get that balance right. So,
but on that point, I've got another 30 years of this. Yeah. And so, yeah, it's been shit, but the important thing is in life, be honest with yourself. Number one, learn your lessons
yeah,
and implement them. And
yeah,
we've got another 30 years left. So, fuck it. I'll be all right.
doubtless, Keith. And the other point is on that it's important to think that you've been lucky rather than clever when you do well, because if you think you're
Well,
clever, no, I mean it,
yeah,
because if you think
yeah.
you're clever, you put yourself in the wrong space and you think that you're fireproof, and
Well, absolutely.
it's
And
not.
frankly, I'm in
It's
this
not.
position because I thought I was too bloody clever, having made loads of money out of the oil cycle last time. Well, turns out I'm not as clever as I thought. Anyway, moving on.
You are pretty clever, Keith. Yes, notwithstanding all of that. So, corporate sentiment indicator continuing to improve. Um,
Yeah, absolutely. So, your point, Richard, corporations making a lot of money, feeling good about life.
yeah. For PE ratio of the S&P X and Mag 7, not particularly elevated, but it's actually quite interesting.
Yeah. However, I would say this is 12-month forward PE.
Mm.
But, the reality is, if you think about the Kalecki-Levy model and corporate earnings being the inverse of the US fiscal deficit, well, the fiscal deficit is enormous, 6.1%. And unless they start cutting the deficit, this is another thing I got totally wrong. I thought expecting that the deficit would have to be reined in because it was so enormous. Well, they ain't reined it in. And that means US corporate profits have been enormous. But
Yes.
in the UK, now going to start Rachel Reeves, 26th of November.
Yeah, I mean, I think the UK and the US are very, very different places economically, aren't we?
Yeah.
So, general principle, which is undoubtedly true, is that the higher the starting PE, the lower the future return is going to be. But again, this is something we've been talking about for years, and it hasn't yet transpired.
Yes, well, exactly. And on to commodities. Quick summary. Well, energy, pretty indifferent. Oil down a bit. US natural gas surged an astonishing 34%. Coal was up a bit. Industrial metals indifferent. Chinese lithium and neodymium were quite strong. Precious metals back at gold back above 4,000. Looks like temporary blip in a bull market. So looking at energy first, Brent down 2% to 64.2. We did an oil market special last week. I hope you've watched that. I think that the oil market we'll have a weak period over the next couple of years, and then he's going to go to the moon. So it's a question of timing your entry. More on that in due course. European natural gas going nowhere. Hurrah! As we enter winter. That's really quite astonishing. US natural gas futures had an amazing week, a couple of weeks, up 34%, now up 24% on the year. So European natural gas futures are down 35, 40% on the year, which is great for household energy bills.
Mm.
Coal recovered a bit, up 6% over the past couple of weeks, still down 12% on the year. Uranium going nowhere. So this is Brent. It bounced a bit on a few weeks ago on renewed sanctions on Russia, but fundamentally, the supply demand imbalance is firmly there's too much oil. So inventories are rising. Global inventories rising, I should say. WTI down 1.5% on the week and drifting off basically. Now we're going to start reporting EIA's global oil inventories number, and these were in millions of barrels. So year to date, we've had a rise of 144 million barrels of inventory. In September, it grew by an enormous 41 million. So OPEC's opening the taps and global oil inventories have been rising. But over the past couple of weeks, the US oil inventories actually fell by 14 million, which is quite substantial, although it's still up on the year.
I
Now,
think, can I just,
yeah.
the other thing, Keith, is that although the year-to-date change is 144 million barrels,
Mhm.
that's 1.5 days consumption. And
Yes.
if you look at it as a percentage of let's say, the August inventory, I can't do that sum in my head, but is it 2%?
Yeah.
So it's an absolute big number, but a relative small number.
Yeah, absolutely. No, I agree. It is, but there is limited inventory in the world. If that was to keep on rising, then you could end up in another situation where oil falls sharply. The EIA is forecasting oil prices in their 50s next year.
Mm.
So, but a lot depends on OPEC, what they decide to do. OPEC are forecast to increase production again next year. If they don't, then bets are off.
I think there's also a question as to whether they really can, isn't there?
Yeah, but the thing is, Saudi can. The thing is, Saudi and the UAE can,
Mm.
and Iraq as well, actually.
The
So,
reason I say this, I have become increasingly distrustful of these numbers.
yeah,
Not these numbers, the numbers that are produced by effectively government agencies.
right.
And if you had taken, if you listened to all of the government agencies, all of the pundits 2 or 3 years ago, I would never have invested in precious metals. Everybody was saying it's a stupid thing to do. And so my sense is that there's a lot of data out there that is at best misleading inadvertently. And you have to be really careful not to get too sucked in by it.
Well, okay. Because I am slightly the opposite, Richard, because I believe the EIA does the best job it can. But I'm deeply skeptical of private commentators in the oil market because they are relentlessly bullish. They all want the oil price to go up, and
Yeah,
they interpret all the data
yeah,
in like everything's tightening. There's, inventories are fake and etc. etc. And the reality is that, the oil market is not strong at the moment, and peak oil, which talks about peak oil didn't happen. Now, I think going forward that the oil price is going to have to rise, as we covered extensively in the oil market special. But The reality is there's loads of hydrocarbons in the world, as I've talked about before. If you were to start exploiting methyl cathrates from the bottom of the ocean, then if you would burn all those, you'd run out of the oxygen in the atmosphere. There's a huge amount of hydrocarbons. Question of the price. Baker Hughes rig count down to 412. So these Dutch natural gas futures, hurrah, entering winter, and gas prices way lower than they were last year, despite lack of Russian gas. We are changing our supply chains. Same in the UK, that's great. US natural gas futures, this is really interesting. So it's actually unseasonably warm in the US. So this is not due to heating demand. LNG demand has been rising, and so the gap between European and US natural gas prices seems to be narrowing. Coal recovering a bit, uranium going well.
On a rather noisy trend,
yes,
upward
exactly.
trend.
Richard, industrial metals.
Thanks, Keith. So, scanning down the right-hand column, it's been a pretty good year for industrial metals on the whole, hasn't it? So, so aluminium up 12% on the year, cobalt doubled over the year, copper up 25% on the year, and it's had a lot of volatility in that process, including being bounced around by Trump's tariffs and non-tariffs and so forth. Iron ore hasn't moved for the year. Lithium carbonate up 7.5% for the year. Neodymium up 40%. Nickel really hasn't changed terribly much. Tin up 23% and zinc up 3.5%. So
yeah,
general trend this year for industrial metals has been upwards with some exceptions.
So I was thinking over the weekend about how I fucked this cycle up, but the your point, Richard, about us running out of commodities, I think is fundamentally true. In particular, copper. Copper actually. The others there's less concern about, but next cycle. Then there's a secular trend. It's just a question of timing your entry into it and whether you want to time it at all, frankly, because going forwards, that we're going to need increasing amounts of copper, and that copper grades around the world have been falling. But the thing is, the flip side of that is that I think oil trumps absolutely everything, and so copper miners use vast amounts of energy, diesel. And so actually, although the copper price will go up, so will their costs. And actually, I'm going to stick to energy.
So there's a sort of there's an intersecting curve, isn't there?
Yeah.
And obviously, if the cost of extraction goes up at the same rate as the price of the refined material, then the margins of the miners stay constant effectively, and there is no share price increment. If, however, the cost of energy input goes up more slowly than the price of the finished material, then margin increases. So at the moment, the cost of energy is low and the commodity prices are rising, which is perfect for commodity producers and investing in the commodity producers. The question would be, where do those curves intersect, and when will they intersect? But they're not intersecting at the moment, in the sense that as material price goes up, the energy price doesn't go up, and margin is increasing. So I think you have to keep your eye on it, and you just have to keep your eye on it basically, and make sure that the cost of energy doesn't effectively cripple the producer. And what will happen, of course, is that it won't reduce the output price of the material. It will just mean that the mining company is no more profitable than it was when the material was much cheaper.
Yeah, that's true. But currently, like next couple of years, I expect copper miners to be very, very profitable. But then, you know, as the oil price starts to rise relentlessly,
Yeah,
then their
it's all down to
profitability.
grade, then, isn't it, Keith? So if you have an above average grade, then you will continue to increase your margins. If you've got an average or below average grade, your margins will drop. So you have to pick the high grade. You have to pick the high grade,
Yes.
the miners with the high grade resources. And that's, I think the way to avoid the trap that you've referred to is to be absolutely religious about going for high grade.
Yes,
High
that's
grade
very
resources.
true. Yeah.
And there's a canard out there which I think I remember Eric Sprott many years ago, and Eric Sprott is obviously a fantastically successful investor, but I remember many years ago he was saying he invests in low grade gold resources on the basis when the price goes up, because they have so much of it at low grade, they can get it out and they're vastly more geared to an increase in the price of gold.
Yes.
Which is true as long as the price of energy doesn't go up. But if the price of energy goes up, it's untrue.
Yes, absolutely. And when I start buying oil stocks, so I'm going to buy some this week actually. I'm going to be buying solidly profitable oil companies that are relatively indifferent to the price actually.
Yeah.
Because I mean there are highly indebted ones. So actually that's the bottom line. Ones with huge net cash, yeah, that can survive the cycle. If you go for like Enquest or Tullow Oil, which have huge debts, then a drop in the oil price could take you out.
Yeah. Yeah. Agreed. So I've got a few charts: aluminium, cobalt, copper, iron ore, lithium, neodymium, nickel, tin, zinc, precious metals. So very good week for precious metals, very good year to date for the precious metals. Not a lot more to say, really.
No, yeah, very well done, Richard.
So we have gold, which I think is going to rise above its. Personally, I think it's going to rise above that October peak.
Well, this is anything to go by. I think you're right.
Flows into gold and silver funds. So this is really, really bizarre, isn't it? I mean, also there's basically been no flow into them, or negative, actually net negative flow into them for most of the year. A sudden spike by retail in October, and then no flow again. But what's going on is this isn't being driven by retail. This is being driven by big investors and by sovereign states, sovereign wealth funds.
Yeah,
that's what's driving the gold price higher. And you have to understand that to know what's really going on. People say the price of gold is really only going to go up when small investors go in. No, it's going up because big investors are in there, and small investors don't really matter the price of gold. And actually, silver is going to go up regardless of what small investors do.
Yeah. Well, I think silver, the central banks don't buy silver.
No, central banks don't buy silver. But did you see that Saudi Arabia, I read over the weekend, is planning on producing something like putting in 10 gigawatts of solar power, which obviously is a very sensible thing for the Saudis to do. But I actually don't know the sums, but how much silver does that use? So there's huge industrial demand for silver. And I think there's probably a burgeoning shortage of silver. I suspect the Chinese are hoarding it. I think the Russians are hoarding it.
Right.
The US has declared it a critical metal.
Yes.
So they're going to start hoarding it. So I predict that silver is going to continue to rise for a while. I don't know what to, but I think it's going to continue. Platinum, rhodium, and palladium.
Very good. Now on to rates. So it's been a different couple of weeks for UK rates. The base rate was held at 4%. And bottom line is that UK bond yields are down from their highs of a month ago, but well up over the past year. Now, so much depends on what Rachel Reeves does. On the 26th, this is US base rates. So this is US yield curve rising again, despite Jerome Powell cutting rates. Now, the market is forecasting a 66% chance he will cut rates again in December, but the US is running an absolutely enormous deficit. And, in contrast, the UK, it has no plans to rein it in. So everyone is bearish long bonds. But US inflation swaps, I was absolutely astonished by this because US inflation expectations are not coming down anywhere near this fast as far as I could see. But the 1-year inflation swap, that's astonishing. 5-year forward inflation expectations are well anchored in the US. People aren't expecting monetary debasement. And the Fed has been quietly involved in a form of yield curve control in that they have been selling their short-term bonds as part of QT, but not their long-term bonds. And as we'll talk about in a bit, they're likely to restart QE shortly. So this is UK 2-year. It's probably up a bit this morning as well. That it's come down. 10-year has hit a near-term bottom. 30-year the same, but medium term, I'm fully expecting this to keep on falling. US 10-year, I think you could say that the downtrend remains intact, but it's rising again. And UK, the gap between UK and US bond yields has narrowed sharply, but it's still well above. Germany rising again. Italy, France, not great. Italy, actually pretty good. When we talk about, politics, the bond market absolutely does differentiate between different countries. Italy looking good, France not so good. This is Greece, Japan. And on to this week's economic data. A quick summary. UK stagflation turning to stagnation. Inflation appears to have hit a near-term peak, and we'll show you some astonishing trueflation data in a second. The economy stable but growing at 1.3% per annum. Not great. EU stagnation. Again, inflation low, but economy growing at around 1.3% as well. So, nothing compared to the US, which is growing well over 2%, and the economy seems stable, but the labor market is definitely softening, although we have limited data. In China, latest data suggests the economy may be weakening. All the usual caveats apply. UK, Richard.
Thanks, Keith. Okay, so this is the NPC voting to cut interest rates, with 4 of the 5 members, five to 4 voting to keep rates unchanged in October.
Yeah, and my Bank of England is expecting rates to settle about 3.5%. I totally disagree. I think it's going to be much closer to 2, and in the next recession will be cut right back down again.
So if I could just comment on that, Keith, I would say you may be right or you may be wrong, but it's not something that I would wish to have as part of my investment thesis because I think it's too uncertain.
Well, that's true, Richard, but that was basically the game I was playing. But obviously I've totally fucked it up this cycle. Because when we talked about 3 years ago, all the indicators were the US is going to go into recession, and it didn't. And essentially, I've been stuck ever since.
I think what's happened is as a general, I think that the vast levels of debt have changed again because the move from sort of classic central bank behavior to a central bank behavior where survival is and survival behavior is not necessarily the traditional behavior. I think that's it's like the yield curve, as you pointed out just now, the yield curve control being undertaken by the Fed. That's not part of the sort of investment thesis for rates, if you see what I mean. Well, it is part of the investment thesis if you think that that rates are going to be manipulated, which I do, but it's not part of the investment thesis if you believe they're just going to adopt a natural, and it's going to adopt a natural process. That's sort of...
Yeah. Well, the thing is, I agree with you, Richard, that high levels of debt change everything. But surely it should change it in the direction of trying to keep interest rates as low as possible. Because the game only works if you can get inflation down, and that allows you to cut interest rates and manipulate long-term rates. Because,
to do that,
because just to finish, in the UK, when you look, this is exactly what's happening. So the Chancellor sees an enormous interest bill and realizes that he needs to get fiscal deficit under control that will allow Bank of England to bring interest rates down, which will improve her fiscal situation and allow her to cut rates just before the next election, cut taxes just before the next election. Sorry.
Yeah, I mean, I agree, but I think that's the point as well, isn't it? That the market won't allow rates to come down because the debt is so high. So I don't think we'll ever see debt rates come down to the level you're thinking of. I might be completely wrong, but I just think that the market will not allow it to happen.
Well,
unless the Bank of England steps in and does QE. And if it does that, then we get inflation and rates have to go back up and just get on this treadmill again. UK net mortgage lending. I saw the house prices are going back up in the UK now.
Yeah, I know. New all-time high.
House prices aren't included in the inflation numbers, of course, but they should be.
Mm-hmm.
Bank of England consumer credit, fairly stable. UK net lending to individuals, fairly stable, actually.
Yeah, that looks all right.
M4 money supply has gone up by 50%. 50% in the last 10 years.
Yeah, not great.
UK construction falling. House price survey month on month up 0.3 in September and year on year up 2.4 in September.
Yes. So UK house prices continuing to rise, hitting a new all-time high.
The economic surprise index.
Yeah.
Comment. Job postings, and we referred last time that this seemed to have flattened out, and it still seems to have flattened out.
Yes.
Which I find quite interesting, actually, because I was very skeptical of it, but now it's actually doing something different. I'm beginning to think maybe it's more useful.
So this is growth by decade for the UK economy.
Yeah.
And you'll see that there was a post-war surge, but since then the trend has been relentlessly downwards.
Yeah, and if you draw a line of the amount of legislation and regulations, you'll see that there's perfect correlation between the two. Now, whether it's spurious correlation, one wouldn't know, but there will be perfect correlation between UK economic growth and the number of regulations.
Actually, I could totally agree with that, because actually GDP growth is not the priority of this country. We have lots of different social and environmental priorities.
And GDP growth will look after itself. Yeah, so house builders' profit margins are plunging, which means that they're not going to be building the number of houses that the government says it wants to have built. And this is where the economic reality hits political ideology. And the house building in England has stalled. And the Help to Buy scheme has destroyed their margins. This is a law of unintended consequences. Boost the economy, get the economy growing, and this sort of thing looks after itself. Okay, there needed to be some planning adjustments, granted, but the key to all of this is not to micromanage, but to step back and allow the economy to grow.
Well, I personally think the Help to Buy scheme was Tory nonsense at its absolute worst.
I mean, there was gross amounts of Tory nonsense, right, left, and centre, wasn't there, Keith?
Yeah, absolutely. Basically, what they did was that, like, it just boosted house builder profit margins.
Yeah. I guess a bunch of numpties.
Yeah.
Okay, so UK truthfully, gosh, it's dropping really quickly, isn't it? As you said, as you alluded to, Keith.
Now, we've warned about UK truthflation many times before, because I mean, there's no way on earth it was like 0.5% in December. But directionally, ignore the absolute numbers, but directionally it has been right.
Yeah,
So, that's an amazing drop.
indeed. Yeah. So, and inflation forecasts are also coming down.
Yeah.
Summary is there for you to read. The bottom line is we've got this big budget on the 26th of November, which everyone is waiting for. Rachel Reeves has got to do things that boost the economy whilst, because they won't cut expenditure, increases the tax take. Pretty jolly difficult, I would say.
Right. I would say there's no way on earth she's going to do anything that boosts the economy. Okay. So because actually we've been wrong about Labour. We thought that they would be pro-market, and they've been absolutely not. But they have been, more sensible. They've stopped chucking money at everything in the way that the Tories have, and they're trying to rein in the fiscal deficit because markets have told them to.
Yeah, completely. But it's such a mess. But I do have sympathy for the point of view that they were left a ghastly legacy. I mean, everything we look at,
Yeah.
the rot started under the Tories.
Yeah.
I'm a Conservative voter. It's so frustrating.
And quickly onto the UK car market. I saw this chart while preparing the weekly, and you see that essentially EU car imports from China have surged, whilst exports to China have collapsed. So I then looked at the latest data on UK car purchases, so new car purchases. This is the 2 September 2025. We're going to go through this quite quickly. So the question is, are car imports from China causing a collapse in sales of European car brands? So this is British car brands, and you'll see that Jaguar basically stopped selling cars in the UK, so they have collapsed. But actually pretty stable. Mini up quite a lot. Chinese car brands, well, I've seen on the streets of London some new brands I've never seen before. JQ, Omoda. And so you're getting big surges in imports of Chinese cars. BYD up sixfold on the year. Omoda up tenfold. And lots of new brands entering the market. This is European brands. Pause, take a look. Volatile, but actually pretty stable. Japanese brands, however, generally weak. Korean brands, stable. American brands actually growing. So when we look at the summary, what it shows is Chinese car sales have surged a hell of a lot. They're basically doubled over the course of the last year, but it has not been at the expense of European brands. It's been at the expense of Japanese brands. So I think what we're seeing is that Chinese cars are competing at the lower end against Japanese and Korean imports. So that's quite reassuring, actually. So this
Life
is
in the old dog yet.
sorry, yeah,
There's life in the British car manufacturing dog yet.
yeah. So this is an Omoda. This is a JQ, spectacularly ugly car actually, which I was driving behind the other day. This is even worse, an Xpeng. Right, and now on to the Renters' Rights Bill briefly, which is another piece of Labour government policy. And this, I'm afraid, is going to have, I think, a really bad effect on the rental market in the UK. My daughter's just left home and is like renting in Docklands. So it essentially abolishes no-fault evictions. So that means that landlords can't evict a family at the end of its tenancy. So it essentially ends fixed-term tenancies. All tenancies become rolling tenancies. And you can only evict a family if you give them, if you want either to sell it or you want to move in a family member, you have to give them 4 months notice, or the tenant has breached the tenancy agreement and stopped paying, in which case you need to get a court order, which we know in realistically in London courts takes about a year. Tenants, on the other hand, can give you 2 months notice. So the it fundamentally alters the rental market in favor of renters. Landlords must give tenants 2 months notice of any increase in their rents, and they can only increase it to the market rate, whatever that is. Tenants can challenge any rent increase they believe to be excessive via a tribunal system. Any rent increase can be brought to the tribunal. No rent increases can occur at the tribunal. So the tribunal can't say the rent's too low. They can only say it's too high. And there are only 34 tribunal judges in the country for 5 million rental properties. So hence, if you get any rental increase, your incentive is to go to the tribunal, who will, while it's in the tribunal, the rent will stay as it was, and you have an asymmetric risk. So it can't increase more than the landlord's demanding. It can only stay where it is. So the tribunal system is going to get really clogged up because 5 million renters will know that it's in their best interest to refer it to the tribunal. And the more clogged up it is, the longer you keep paying the old rent. So essentially, pause, read this. But the bottom line is that you're removing the price system from the rental market, and any landlord is now, it's going to be difficult for landlords to make money, basically, but yet again, so expect them to sell up. Richard, your thoughts?
Well, it's going to, over the course of probably the next few years, it's going to take out a large proportion of private rental from the market, isn't it? But those properties will then come on the market. So the flats, the blocks of flats that are mostly owned as buy to let will come and people will be able to buy them. That'll reduce the prices, but effectively, it's completely changing the nature of the private rental market, and the consequences are, I would say, impossible to predict, but are not likely to be good. And I think there used to be a good incentive to operate a buy-to-let property if you're an individual. There were tax incentives and so forth. Slowly, that's all being ground away, and now this is sort of basically, as you say, switching the onus onto the tenant, and the landlord's doing you a favour. Sorry, the tenant's doing you a favour as a landlord, and it just completely distorts the market. And I don't know what the consequences will be, Keith. I really don't. But I do think it's yet another piece of government interfering, not just Labour government interfering in areas of the economy which they don't understand the consequences of, and which are what is driving this economy, this country, into the ground. Is that clear enough?
Yeah, well, because they're economically illiterate, as far as I'm concerned. They haven't thought through the consequences of this.
They never do. I mean, they are all our politicians, even the much vaunted chancellors going back 2 decades, are economically illiterate. It's a requirement of the job.
Yeah. Onto the EU, gone.
Well, they're economically illiterate as well. Same problem.
Yeah.
So all right, onto the EU. Okay, EU. So EU interest rates unchanged. The CPI 0.2% on the in October, and year on year 2%. So inflation fairly well controlled, and the core at 2.4% likewise. I mean, of course, 2% inflation over 50 years is an awful lot.
It is, yeah.
And really, we should be aiming for no inflation, but that's not what these people want. So PPI month on month is falling, and year on year it's falling as well.
Yeah.
GDP, EU GDP quarter on quarter is 0.2%, year on year 1.3%. So the UK middle of the pack really.
Yeah, absolutely. 1.3%, not great. Half that of the US.
Which is why I don't see how the US dollar can fall. Fundamentally. Retail sales in the EU month on month down, year on year up 1%, which is sort of in line with GDP growth. Unemployment rate 6.3%, unchanged low.
Yeah, absolutely.
Consumer confidence -14, but it's sort of established a new baseline, hasn't it, over the last 2 years?
Yeah, not too bad actually.
On EU industrial sentiment, I mean, you could say the same thing. It's a new baseline since mid 2023.
Well, declining energy prices in the form of falling natural gas, presumably, is good for industrial sentiment.
Should be, shouldn't it? Service sentiment just on a steady downward slope.
Yeah, that's a bit rubbish, actually.
It is, yeah. EU consumer inflation expectations are actually quite high and quite a sort of upward trend. And selling prices expectations the same.
Well, that's not that bad. It's, below 2019 levels.
Yeah, I suppose, has it flattened off in 2025? Construction PMI, very, very noisy chart.
Yeah, it is, isn't it?
Economic surprise index. Germany, indeed, job postings, that looks like it's plateauing as well.
Yes, it does.
And France is not plateauing. France is still falling.
Yeah, although I notice that the chart must have changed because last time I reported it was 111.6. Yeah, so.
Yeah, they've adjusted it. So this huge target to balance that Germany has with the rest of Europe, where basically it's sold goods to Southern Europe and sold it on credit, effectively being lent by German banks. So when the Eurozone collapses, Germany is going to take a most fantastically large write-down. Is that a billions of euros?
Yes, billions.
So Germany will take a write-down of,
a trillion.
Where is Germany? A trillion euros, yeah.
Yeah, it's a big bright blue bar.
Like 20% of its GDP or something.
Yeah. So Robin Brooks had this big piece on his blog about what will happen when the Eurozone collapses.
Is he saying when, not if?
He's saying when. He said it's going to have to collapse at some stage because fundamentally they're not the whole way they're handling the fiscal imbalances is not by forcing governments to rein them in, it's by subsidizing them.
It's interesting because I've been of the view for many years that the Eurozone is going to collapse. So it's interesting that Robin Brooks is now saying it. And I was reading over the weekend that, so did you know that the hamburgers have voted effectively to make Hamburg pretty much a car-free zone?
Oh, right.
Which is going to destroy the Hamburg economy. It was voted for by about, I think, 14% of the population because it was a low turnout, etc., or very low percentage of the population, far below 50%. So that's one thing. So they're going to destroy their own economy, and also that Germany has been making enormous subsidies for the hydrogen industry.
Yes,
and the hydrogen industry's gone nowhere. Because it can't go anywhere because it's a whole infrastructure that needs, huge infrastructure needs to be built, and even these big subsidies of 8 or 10 billion euros. So effectively, they're going to stop subsidizing the hydrogen industry in Germany, which is going to collapse, and subsidies will effectively have been wasted. There's this whole net zero charade that politicians have been kidding themselves that by wishing it will come true, is falling apart, that having caused huge economic damage to themselves. And actually, ironically, I think if they'd not caused this huge economic damage and were following a more rational path, they would be a lot further on towards net zero with much stronger economies.
Yeah, well, I mean, closing down nuclear and then burning brown coal. I mean,
Crazy.
what were they thinking?
Crazy. So there's our summary: stagnating, no sign of a productivity boost from AI.
Thank you, Richard. On to the US. Obviously, US government shutdown means there's relatively little data. So we're relying on private sector data. ADP are forecasting that US employment rose by 42,000 in October, bouncing back from a drop in September and better than expectations. So US economy stabilizing. Now, Revelio use 100 plus million US profiles that mirror the national workforce and cover 2/3 of all employed individuals. And they're saying that in October, the US actually lost jobs. But you'll notice that in previous months, it had been saying that the US economy had gained jobs when the BLS was reporting it had lost jobs. So there's some uncertainty there. And this is from Revelio. They're saying that the biggest contributors to the fall in the US workforce were government, unsurprisingly, retail and manufacturing. You'll notice that construction continued to add jobs. ADP's payroll data, which we've covered, shows background is a weakening labour market, basically, slowly slowing. The Chicago's Fed unemployment model says that it's expecting unemployment to keep on rising. And Goldman Sachs are estimating that continuing claims have bounced back while the government has not been reporting them. Truflation, though, has this new employment index, which says that employment actually rose quite strongly in both September and October. Now, we know the non-farm payrolls data for September was quite weak, but there you go. Now, something that spooked the market was the Challenger job cuts data, which was unexpectedly nasty in October. Challenger reported 153,000 jobs being cut. Now,
is Amazon a big chunk of that?
It is. Now, we should say that this is just announcements made during October. So those announcements could include historic job cuts or future job cuts, such as the Amazon one. So it's not, there's no direct correlation with actual unemployment. And the main contributors to the rise in job cuts was technology, i.e. Amazon, and warehousing. And so as AI, the big tech companies have been investing more in AI, they're looking to cut costs, laying people off. And rising layoffs and rising unemployment tend to go together, as you'd expect. But the Challenger job cuts numbers are actually quite large. So over the course of the last 10 months, according to Challenger, US employers have cut 1.1 million jobs. That is a lot. Look at this chart. We're 10 months of the year in. We know hiring is difficult. That's a bad year. It's one of the worst years on record for layoffs. So the US labor market appears to be weakening. And when you look at all the indicators, green is good, dark red is bad. Just the general impression is of a slowly weakening labor market. ISM manufacturing PMI is weakening again, but pretty stable in truth. The employment index, not great, still below 50. So manufacturing employers cutting jobs. ISM services, this was reassuring. The market liked this. And in particular, new orders were very strong. So 56.2. Now, all these things are volatile and you've got to be looking at the trend, but the absolute number is quite weak. RCM TIPP Economic Optimism Index, which is a survey of US consumers in November, it took a hit. Not good. And moving on to the University of Michigan consumer surveys, they're all very bad. So consumer sentiment in the US being adversely affected by the US government shutdown. 50.3 is a terrible number for the headline number. This is current conditions, 52.3, terrible. Expectations, terrible, 49. All these down near all-time lows. 1 year inflation expectations, well, the market has inflation expectations coming down, but consumers' expectations are stable, about 4.7%. 5-year did dip to 3.6. House prices in August, weak, actually surprisingly weak, down 0.6%. If you kick out a load of illegal immigrants, you're reducing one of the buyers, and marginal demand and supply is moving towards weaker demand, but still at 1.6% year on year. But house prices very rarely fall in the US, generally around recessions. Conference Board Consumer Confidence Index also down, but much stronger than the University of Michigan. Initial jobless claims, there's no data currently. Indeed, show that job postings continue to weaken. LinkUp confirm weakening job postings. Dallas Fed, obviously all of these nowcasts are affected by lack of government data. It's saying the market economy is stable at 2.2%. Atlanta Fed say it's really strong at 4%. New York Fed explicitly warn that their forecasts are less reliable because of a lack of data, but they're saying 2.3%, which seems about right. St. Louis Fed, again, 0.6%. Economic Surprise Index, stable at 12.5. Trueflation, that's up a lot over the past couple of weeks. The trend is not in the right direction. And we've shown you this before, but the ISM Prices Paid Index is well correlated historically with CPI with a 6-month lag, and it is not very encouraging, frankly. I thought this was absolutely amazing. This is from the Fed Beige Book, and it shows that 82% of Americans are living in regions that are in a recession. I struggle to believe that, but there you go. The freight industry is in recession. Actually, freight volumes are down an astonishing 17% year on year. Amazing. And in the biggest tech boom / AI boom in history, a third of San Francisco office space is vacant. So the bear market in offices has not gone away. Thank you to Wayne J for that chart. And this is a really interesting chart. If you take away one chart from the weekly this week, look at this. So spending on data centers has shot through the roof. All other construction is quite weak. And essentially that is propping up the US economy. CapEx growth is matching the tech bubble. And business investment, while we're on the same subject, business investment, essentially it's all IT, everything else is quite weak. But high earners are doing okay. This is the year-on-year change in luxury spending, and breaking a long run of negative year-on-year numbers, it's ticked up. The relative performance of consumer staples companies in the US, though, confirms that US consumers are not doing so well. But on the fiscal deficit, in the year to September, tariff revenues mean that the budget has improved slightly, the deficit has improved slightly. You're looking at the brown bar, which was tracking above 2024, but the gap has been narrowing and now it's below. And that was before the government shutdown. So, in summary, the labour market is weak, but not necessarily contracting further, although we did get a lot of job losses in October, according to Challenger. But the nowcasts show that the US economy continues to tick along thanks to investment in AI. And on to the legality of US tariffs. Obviously, Trump has imposed huge tariffs on the rest of the world, which is making him tax revenues of about 1.2% of US GDP every year. And as we've just seen, that has actually had the effect of tightening the US fiscal deficit. But in January, the Supreme Court will hear the first oral arguments that Donald Trump has overstepped his authority in imposing these tariffs. Now, in recent days, prediction markets have tightened their odds that he's going to lose, that the Supreme Court will actually side with the lower courts in saying the president has overstepped his authority. But that's unlikely to be the end of the tariffs. He has at least 5 other routes by which he can go in imposing tariffs before he has to go to Congress or the Senate and try and formally get a bill passed. But pause, have a read. All the other avenues he could go down come with more limitations. For example, injury to domestic industry. He can only impose tariffs for 4 years, extended to a maximum of 8 years. Presumably he won't care because he'll be out of office by then. 50% phase down required after 1 year. They all come with limitations. So the bottom line is Trump may well lose this case, but I don't think that will stop him. I think he'll just find another way of doing it. Richard, have you got any thoughts?
I'm sure that, I don't know what the Supreme Court's going to say, obviously. I'm sure that he will find another way of doing it. I also, this is an apolitical point of view. I think the constant imposition of the Supreme Court I think it's must be very disruptive for US politics, and the whole US system is such a mess. It's very hard. It's hard to know what the right thing is. Obviously the imposition of tariffs hasn't had the disastrous economic effect that some people thought it would have.
Yeah.
At least not yet.
Yeah. No, I totally agree with that. I mean, it's been really surprising how little effect it's had.
Yeah. So at this point in the game, it feels a little bit like a storm in a teacup. Now, I know, but if he has technically overstepped his executive authority, he's overstepped his executive authority.
Yeah, but frankly, he'll just overstep it somewhere else, is what I think. Yeah. He shows no sign of actually wanting to obey the rules of the US Constitution. So, why you expect, if they say he's overstepped the mark, then he'll just overstep it somewhere else, as far as I can see.
Precisely, yeah.
Now, you'll enjoy this one, Richard. Okay,
yes.
So the Whitehouse Ballroom, we've talked relentlessly on this podcast about how, the US inequality has been growing, and the poor are suffering from lower wage growth and lower real wages because inflation has outpaced wage growth, particularly the cost of housing, etc. But meanwhile, Donald Trump is building a ballroom. And, okay, so this is the White House as it is, okay? So I was unaware that it had these, 2 wings. I suppose there's that TV series, The West Wing, wasn't there? Should have alerted me to the fact that it has this huge extra sides. But anyway, here you go.
Actually, that's the plan, is it?
Yep.
90,000 square feet.
Yeah.
Big, isn't it?
I mean, that is absolutely enormous.
I mean, it does rather dwarf the White House itself, doesn't it?
It does.
Proportionality isn't his strong point, I guess.
Well, I mean, it's a huge addition. So this is where we are now. So
Yeah.
the East Wing has a calligraphy workshop. So when you get invited to the White House, they will have a calligraphy workshop, which will individually write you an invitation.
It's sort of yeah, it's big. It's
It's
big.
it's big. It's absolutely enormous. And this is the inside.
Very nice. Yeah,
It's huge.
it's lovely.
It is lovely. You know, um, you'll
And
get an
Versailles,
invite, Richard, for your
yeah.
services to Global Metals.
Thank you, Keith. I think it reminds me of Versailles,
It does, doesn't it?
the
Yeah,
Sun King.
yeah, white and gold. Bottom line, well, currently the US government is shut down, but Donald Trump's stated #1 priority is this construction of the Whitehouse Ballroom at an estimated cost of 300 million. Actually, I'm quite impressed with that number. I would have thought it would cost more.
Doesn't sound that much, does it?
Yeah. Trump claims they're paid for by private donations. 68% of Americans are living paycheck to paycheck, as we showed you that chart last week.
Yeah.
There you go. Invest a billion so elect a billionaire as president. His priorities are not necessarily yours. And on to China. Richard, do you want to do this?
Chinese CPI is in fact falling slightly. It's been on a downtrend, really. It's fallen since mid-2022. It's slowed right down, but it is still possibly on a gentle slope down.
I find this really interesting because we've had an ongoing debate about demographics. Now we've got a chart at the end of this section which shows the birth rate in China, and it is astonishing. So in the 60s, the birth rate was 33 million per annum. It's now 9. Okay, and it's going relentlessly in the wrong direction.
Which
so you've got an aging population.
Yeah.
Now, shouldn't you be getting inflation? Question mark.
So there we are. Chinese PPI down to 2%.
Yep.
Running fairly level at 2% per annum.
Well, this is what you would expect when the investment policy has been relentlessly towards manufacturing capacity. So, yeah, you productivity improvements in manufacturing mean lower prices.
And PMIs very slightly. I mean, it's basically bumping around 50, isn't it?
It is, but
for a long time. Services PMI likewise, and the general PMI very shallow downtrend perhaps, but nothing notable, I would say. Balance of trade slowly falling actually.
Yeah, well, they had a lot of pre-tariff surge in production and exports, and now that's fading.
Yeah. Chinese exports year on year.
Yeah.
Not a huge change. In fact, not really, apart from that spike in 2021. Really, it hasn't changed terribly much for the last almost decade.
But the October number was minus 1.1% year on year.
Yeah, but September was up 8.3.
Yeah, true.
Chinese imports year on year up 7.4 in September, but only up 1% in. And it's a bit spiky, it's a bit noisy.
Yeah, that's true.
I guess. This is what Keith is saying about the birth rate, which is dropping significantly.
Yeah. Now let's think about this. 9 million babies a year. Let's say they live for 70 years. So that is going to put your population at 630 million. Yeah.
Yeah.
If it stabilizes at 9, which it shows no sign of doing. So, according to official stats, the population of China is about 1.1 billion. So it's on track to fall, 45% over the next 50 years?
It is, but this is what the world needs, isn't it? And the world needs a smaller human population for it to be sustainable. So whilst it will have economic consequences in terms of looking after the environment and the planet, it'll be very good, not just in China, but everywhere. And it's like, you can't have your cake and eat it. And what always strikes me as bizarre about economists is how they bemoan the quote demographic crisis whilst also bemoaning the crisis of the environment. And you can't have it both ways.
I totally agree with you.
So inflation is quiescent in China. Exports are a bit down. Not surprisingly, PMIs are around about 50. So is the Chinese economy slowing down? Don't know. Difficult to see.
It's difficult to tell, isn't it? You can't trust the stats, basically.
Yeah.
Okay, thank you, Richard. On to one chart. Now, I thought this was really interesting. Okay, so the red line is the year-on-year growth in adjusted earnings for the Mag 7. The light blue line is for the rest, the S&P 493. And the forecasts are that earnings growth for the Mag 7 is going to converge on the rest of the market by the end of 2027, so in 2 years' time, which would imply if their earnings growth falls to that of the rest of the market, then so should their PE ratios, question mark.
Yeah.
And as the Mag 7 currently have a forward PE ratio around 36, and the S&P 493 has a PE ratio of 19, and that's assuming that the forecasts are correct, which frankly I question, then that implies quite a large drop in their share prices. And we showed you this chart earlier of their relative, their forecast PE ratios relative to history. But, and I'm going to caveat this by saying, this is an earnings story. It's not a revenue story. So actually, when you look at the forecast revenue growth of the next year, is not forecast to slow that much. What is forecast to slow is their earnings growth because of AI spending. So if they keep up the revenue growth, then perhaps not.
It's difficult to know, isn't it, Keith? I mean, we shall see. My attitude to all this is I have no idea what's going to happen. I don't know what AI is going to do to employment and unemployment. And it's a little bit like, therefore, I exclude it because it's so unknowable.
Well, the thing is, Richard, your strategy, I mean, basically, you don't care about this stuff. You only you know about commodities. That's it, isn't it? Which, frankly, I'm coming round to.
Yeah.
Having got this relentlessly wrong.
It's just so unpredictable.
Yeah. So at the last Fed meeting, the Fed announced it would stop QT at the beginning of December. It is likely it's actually going to have to restart QE.
Yeah.
Now, this is something that presumably will fill Richard with joy because it's, it's pumping liquidity, which will end up in the gold market.
Well, it fills me with a sense of inevitability, really, Keith, because it is to my mind, I may prove to be wrong, it's the only way that the US economy can sustain it. And effectively, it's just inflationary.
Right. Yeah.
And that was my original gold thesis, that QE can't stop.
Yeah. Well, on that note, so the reason is technical, really. So the US government have been refilling the Treasury General account, which, reminder, is the government's bank account. Basically, they spend dollars from the TGA account, and they've been refilling the TGA account by selling Treasury bills, that's short-term US government bonds. And that has pulled around $1 trillion out of the system, out of the liquidity out of the system, and that is mainly from banks. So banks have been buying T-bills, which means the banks have been running out of liquidity. So in order to get cash, they have been turning to the repo market. So repo loans are basically short-term loans which use treasury bills as collateral. And you'll see repo volumes have been growing very steadily. But that tightness in bank liquidity means that the Fed essentially appears to have lost control of interbank lending rates. So what you need to look at now is SOFR, which is the overnight rate at which banks lend to each other. Now we know that the Fed just cut rates to a range of 3.75 to 4%. So the deposit rate is 3.75%, and that is the rate you get if you deposit funds with the Fed. The overnight rate is 4%. That is what the Fed will charge you if you want to borrow short-term overnight from the Fed. And you see SOFR is at 4.22%. So banks are lending to each other at rates higher than the Fed overnight rate. So the Fed setting its interest rates between 3.75 and 4%, it has not got control of the interbank lending rate, which is too high.
Well, this is my point. This is the point I make about the inability of central banks at some point to control interest rates, Keith.
Yeah.
Which is why I think that interest rates won't fall so far, because ultimately, if the market doesn't want that to happen, the central bank can say the interest rate is what it likes, but the market is free to charge whatever interest rate it wishes on the open market.
Well, that's true, Richard, but I think the Fed has got vast tools it can use to manipulate it. I mean, we're now going back to a sort of Austrian argument where, the Austrian school will say, well, central banks are terrible because they manipulate interest rates, move the interest rate away from the natural rate of interest, which which should be set by the market, and in doing so, they push the economy out of equilibrium in generally an inflationary way.
Yeah.
So in order to deal with that, the Fed has been injecting liquidity into the banking system via reverse repo operations. That's 125 billion over the course of the last week. Richard's point, liquidity being pumped in, but various commentators, particularly Joseph Wang, who used to work for the Fed and blogs under the name Fed Guy, estimates that in order to ease stress in the interbank market, the Fed will need to inject liquidity via QE. And so he estimates they'll do so by between 300 and 500 billion a year. To put that into perspective, in 2021, it expanded its balance sheet by 1.4 trillion. So that's not a huge amount. It sounds like it. And I'm going to read this out. The macro implications for further Fed balance sheet expansion should be small, but could be perceived differently. High reserve levels most tangibly act as an interest subsidy for banks. Several hundred billion reserves would increase banking sector interest income by about 10 billion. Some investors perceive a growing Fed balance sheet as risk positive and may position accordingly. So he's saying that it'll be a bullish because people want it to be bullish. Everything okay? Do you want to make any comments?
I suppose, I've always been expecting that QE will begin again. And I think that this is not a surprise, actually, to me. And I agree, fundamentally, I agree with the Austrian point of view of economics that central banks are possibly more of a burden than they are a benefit.
Yeah.
And they certainly presided over massive inflation since over the last 100 years or so.
Yeah.
And there is a point at which they cease to be able to control what they purport to be able to control.
Well, the trouble is, Richard, when you've kind of got debts of 120% of GDP, which the US has, and you're running a deficit of 6%, then there's only so much monetary policy can do against this flood
completely
of government spending.
Yeah, I mean, it's just fundamentally it's inflationary, isn't it? And yet, so they don't want inflation. They're stuck between a rock and a hard place.
Well, but fundamentally, what's happening in the US is that, let's think, you've got 6.1% fiscal deficit, but you're only getting growth of what, 2.3%? Yeah. And so you're not getting much bang for your buck. And I think what's happening is that inequality is such now that a lot of that spending is feeds through the corporate profits, dividends go to rich people save it.
Yeah. And so effectively, there's a short circuit. I believe it's called the Cantillon effect, isn't it? Where the people closest to the money hose, the money spigot, benefit most. And that is Wall Street bankers, lawyers, etc. The big consultancy firms, all those people, they benefit. And then the further away from it you are, at some point you reach the benefit becomes negative. And for that 67% of people who are living paycheck to paycheck, the benefit is become negative and will become increasingly negative as more money is printed, until the system completely breaks. You have to hope the system will not actually completely break.
Yeah. Very good. The Cantillon effect is one that I read about many times and then I forget about it.
Yeah.
So,
I mean, it's London house prices, is, to my mind, London house prices Cantillon as well.
The Fed, bottom line is the Fed will once again be interfering in the money market to manipulate interest rates lower. On Richard's point, the huge fiscal deficit is crowding out the private sector and would naturally force interest rates higher, but the Fed is going to intervene to get them down. So last segment this week, and it's a big one. And thank you very much to our Discord member Simon W, has played this cycle immensely well, unlike me, and who has been talking about how the bubble is not over and how to play it. So here we are, Bubble Watch. Now, you may remember this chart. Simon sent it to me again. This is the pathway of a bubble in the stock market or in any asset. Basically, it really gets going when prices are going up and people start buying simply because prices are going up. And that tends to lead to an acceleration in asset prices, then a double top, then as people get out, then a fall leading to basically everyone not wanting to even think about it for years, prices going too low, and then normalization. So pause, have a read, but it's driven by greed basically, and everyone ignoring the fundamentals. So let's go through some earlier bubbles. This is always fun. So first one that people generally talking about is tulip mania in Amsterdam. A reminder, the Dutch essentially invented the modern stock exchange and had the most advanced economy in the world in the 17th century due to innovations in finance, i.e. the stock exchange, and also in international trading through the Dutch East India Company. And a speculative mania developed over tulips which had been originally imported for Turkey, and particularly the ones with variegated leaves. And prices went through the roof and then collapsed. Now, economic historians have recently done work on this, and what they've shown is there was a bubble. This is not just folk myth, but it was relatively limited to just the wealthy merchants, and it had relatively little impact on the whole economy. But as we go through time, the bubbles get bigger. So this is the South Sea bubble in 18th century London. speculation around the granting of monopoly by the British government to allow the South Sea Company a monopoly on the trade with South America. Essentially, it never really did much trade, but just the prospects of trade with South America, which they knew the Spanish were making vast amounts from, led to the share price going through the roof. And Isaac Newton famously re-entered close to the top and lost a third of his wealth. Now, an important thing to realize about bubbles is that there's plenty of liquidity on the way up. On the way down, liquidity disappears. Everyone rushes to get out and there aren't enough buyers. So you get these big gaps down in prices. Pause, have a read. Most of you will know this story, but basically, as the South Sea Company's share price went up, so there are loads of IPOs of small speculative companies, all of which got listed on the stock exchange. And some of the most notorious were a company for carrying on an undertaking of great advantage, but nobody to know what it is. And so he sold his shares and then ran off to the continent, etc. Now, so what's interesting about these companies in the 17th century was, although the shares were issued at a par value of £100, you only had to put down an initial £2 to start trading the shares. The shares then traded at a nominal £100. So your shares trade on the stock market at £100, you put down 2, the next day the shares go up to 505. Actually, you can sell them at 105 and you will have made £5 from your £2 deposit. So it's a sort of very leveraged way of playing the stock market. But when the £100 comes due, you are legally liable for it. Although, essentially, your collateral was your shares, so they'd just sell your shares. So basically, it was kind of the most you could lose was your £2. Okay, moving on to the railway mania of the 1840s. So you're looking at the blue line, and see how long this lasted. So the early railways in Britain were immensely profitable, and then everyone started building them. And of course, as supply massively increased, so profitability collapsed. Famously, 2 separate lines were built between London and Bristol. And while we're on that subject, so Tim Harford of the FT was talking about the economics of bubbles and whether they're a good thing or a bad thing. And he was saying that, everyone is saying, well, bubbles, they leave behind great infrastructure, etc. And so we shouldn't be worried about them. Some people lose money, but, the net result is that they're good for the country. Think about .com, where built all these undersea cables, and we're left with great communication networks. Well, he was pointing out that during the railway mania, everyone built railways without any centralized planning. And essentially, the UK was left with a railway system which is suboptimal and a bit of a mess. And it would have been much better if it had been centrally planned. And the UK has essentially been trying to deal with this mess of a network ever since.
That's interesting.
So this is the gold price in the 1980s, set in 1970s. So it went from $35 in 1972 when Nixon took the US off the gold standard, and then it rose to a high of $667. So that is a 20-fold increase in 10 years. And that was caused by worries about inflation, speculation, and global geopolitical instability. Now, it's peaking during the Iranian Revolution, when there were worries about global oil supplies, etc. Japan in the 1990s, famously, the land under the Imperial Palace in Tokyo was worth more than all the buildings and land in California at one point. And then when the stock market burst and the real estate bubble burst, the stock market, well, 20 years later, is still well below its peak. The economy suffered a lost decade. So bubbles can have a terrible effect. Now, the big question is, in a bubble, when do you get out? So we're going to go through .com, which is the next one, year by year. Now, this is the Nasdaq Composite as of the 1st of January 1995. The P/E ratio is a reasonable 15, and it's had a decent year, rising from what's that, about 450 to 750. 1st of January 1996, great year, up 35%. The P/E ratio has increased a bit to 18.1. That's about, where the S&P 500, S&P 493 is now. Yeah, so S&P 493 just a bit above this. 1st of January 1997, another fantastic year. Now, during 1996, Alan Greenspan warned that stock prices were displaying irrational exuberance, and a young fund manager called Keith Jordan decided to get out of the market altogether. Seem familiar? 1998. Towards the end of 98, you had the Russia crisis and the Asian crisis, but the market ended the year 13% higher despite a bit of a wobble at the end. Notice the P/E ratio is creeping up because loads of unprofitable .com growth companies were being listed on the market. Do you get out now? P/E ratio 33, very high, well above historic norms. Well, that would have been a mistake because the market looked, after it recovered from the LTCM, it was off to the races. 1st of January 1999, return for the year 55%. So it starts the year here, 55% rise. The P/E ratio is now an astonishing 73 for the Nasdaq. Get out now, Richard?
I reckon so, Keith. Yeah.
Yeah, I'd get certainly. Well, I would have got out back here, frankly. 1st of September 1999. Return year to date 23%, so it's kept on marching higher. The P/E ratio is an astonishing 110. So at this point, you're expecting enormous earnings growth for the whole market. Now, where that earnings growth is going to come from is you'd have to have a huge increase in either profit margins or the whole size of the economy without inflation. Don't get it. But anyway, if you got out then, and I certainly would have got out then, that would have been a mistake because 2000, it goes up in a straight line. And the return for the year 2000, so that's 1999, 2000, you got a 65% year. Just absolutely mind-blowing. The P/E ratio is about 150. Do you get out then? Question mark. I certainly would have been long out by now. But that would have been a mistake because in 2 months, it goes up another 30%, hitting a P/E ratio of 200 for the entire index. But then you need to have got out. The year later, it has fallen 52% from the peak in 10 months, sorry. And it's down 38% on the year. And everyone who's getting in towards the top has lost a lot of money. A year later, it's down another 17%. It's down 60% from the peak. It's still not back down to where I probably got out in 1996. Do you get back in again? Richard, do you get back in again?
Well, I know the answer to this question, Keith, but this is what's so difficult about bubbles, isn't it? I mean, it's why people, this is why they exist and why people lose so much money.
Yeah, well, has it bottomed? It's actually up a third from its bottom at that point.
Yeah.
That looks like, good time to get back in. Yeah. Well, that would have been a bad decision because it goes right back to new lows. From that point there, the beginning of 2002 to its trough, that's another, what's that, 40% decline? And now it really has bottomed. When bubbles burst, you need to be really, really careful about getting in too early. Just wait. You have to wait for the repudiation phase where everyone is just thoroughly sick of it and never wants to hear about .com or whatever again. And you'll notice that actually the PE ratio peaked in 2002, well after the bursting of the bubble, because the everyone was losing money at that point, and you'd listed a load of .com stocks which were hanging on. They'd raised money, so they were kind of zombies until they died, and that took a few years. So here you are. This is the PE ratio of the NASDAQ composite in red. Hit an astonishing 500 in the aftermath of .com. So lessons from .com. Bubble took 3 to 5 years to inflate, with several double-digit drawdowns along the way. Share price accelerated towards the top. The NASDAQ doubled between June 1999 and February 2000. The initial drop was 35% in 2 months. So when it starts to go, you need to get out soon. But it was then followed by temporary recovery, classic double top sort of thing. And the bear market then lasted 2.5 years. So, frankly, it looks so much like this chart. You have to think that this chart was designed from the experience of .com. So the question is, where are we now in the AI bubble? Nvidia, P ratio of 58, market cap of $5 trillion. This is the NASDAQ composite. PE ratio of 35, is that? Now, by every metric, the US stock market is overvalued. The Buffett ratio, for example, is at an all-time high. This is market capitalization of publicly traded stocks versus GDP.
The problem with these things, Keith, though, to be fair, is that you really need to isolate the Mag 7.
Yeah.
So what are all these ratios excluding the Mag 7?
That's true. But the Mag 7, they're
because
a huge
the Mag
chunk
7,
of the market these days.
We're talking about a Mag 7 bubble, not a everything else bubble. Or if we are talking about an everything else bubble, it's useful to know what it is.
Yeah, no, I agree with that. But unlike .com, the Mag 7 are very profitable. And so the P ratio here, the 5 largest stocks, is 40% lower than a peak of .com, but it's still very high. And note that this chart uses forecast earnings. The P ratio of the overall market is high, but not at .com levels. Gold has also done very well, as has silver. So the question is, where are we now? Now, Simon W., who's played this very well, does not think we're towards the top. He thinks we're due a correction, but it's not a top. The Fed is easing. There's no frenzy. We haven't had an exponential rise recently, but another Fed cut could start the frenzy. In the last day, we've seen gold taking off again. And so these charts are for him. He thinks we're about here, halfway. And he's saying that he thinks the half time in the AI bubble would be about July next year. We've not had the blow off top. This is a chart of the NASDAQ composite, and the yellow line is if there were to be an acceleration in share prices where you'd get to very high absolute levels. These are some these are the best investment themes of each decade. And if you get hold of one and stick with it, you can make one hell of a lot of money. But notice that the 2020s, initially in 2022, it looked like oil. Well, it wasn't. It turned out to be the FANGs or the MAG 7.
Yeah.
So in summary, bubbles are rare and are characterized by rapid rise in asset prices, yes, that far exceed fundamentals, I'd say yes, fueled by excessive optimism, speculation, fear of missing out, and herd behavior. So Simon's view is, yes, we're in a bubble, but bubbles are a great way to make wealth as long as you've have the discipline to get out at the top.
That's the crux of it, isn't it, Keith?
It is.
And
so
crystal ball to do so.
Yeah, this is the hyperscaler capex estimates year by year, and this is all already in the price. I mean, they're full, in order to just justify their current valuations, you have to think that that's going to get even higher. So my thoughts, obviously, as I did in the 1996, I basically stayed out of this one, which has proved to be a huge, an expensive mistake. But there will be bubbles in the future, and this has taught me a real lesson. Actually, next time I'm going to stick a load into it and just see what happens. And I probably won't go into. I'll just stick it in the NASDAQ or whatever, and then average in rather than staying out, because you do, when you look at the charts, you do have time to get out. It's a question of having the volume. Is there volume to get out? You're dealing with small shitty companies, you don't. But the thing is, in Nvidia, you absolutely can get out very quickly. So Simon W's thoughts, yes, it's a bubble. Bubble's a great opportunity to build your wealth. What's the 30% loss on exit if you've made 5 times your money going up? It's difficult to argue with that. Hold for now, wait for the blow off top. Richard.
That is the point, isn't it? You need to get into it at a point where you have a big margin of safety.
Yeah. The other thing I'd say is that you need to get in early, but above all, as the bubble develops, you need to move from small illiquids plays. I mean, this is not necessarily relevant now where the speculation is in big AI companies, but the breadth narrows and you need to concentrate in the most liquid stocks so that you can get out when it bursts, because when it bursts, the liquidity disappears. An aside is, so this is not a bubble. In the 70s, the oil price went from, what's that, $4 a barrel to $36 a barrel. But that was actually simply supply and demand. It was OPEC attempting to restrict supply onto the market, and in a time of geopolitical tension. Now, the aftermath of that was the very high oil price incentivized non-OPEC, non-national oil companies to go around the world searching for new supply. And so the 80s were characterized by a flood of oil coming on from new oil basins, for example, the North Sea, which kept oil prices low for all the subsequent decades. So a rise in prices need not be a bubble. So finally, on to good news. And this is great, actually. So this shows the UK in a very positive light. So this weird looking deer is Pear David's deer, and it is native to the marshlands of eastern China. But it was hunted to extinction by the turn of the 20th century, around 1900.
Yeah, well.
But at that time, the Duke of Bedford acquired a few of these from Berlin Zoo. and then he built up a large herd at his estate at Woburn Abbey. And then in 1985, his great-grandson, the 14th Duke, donated 39 of them back to China for a reintroduction program. A second reintroduction was done in 1986 with 36 more from 5 other UK zoos, and now they've grown to a herd of 8,000. So the reintroduction is going really well, and it's all down to us. Hurrah!
I hope the Chinese bear that in mind when they destroy our economy.
Yes. So concluding comments. Well, we've had the market's gone up and then it's come down again. Have we had, is that a pause in the bull market? It seems like it is, frankly. And the political tide appears to be turning against Trump in the US in a small way. But,
yeah, I think it's a bit early to say that. Personally, I think, there was a setback in New York.
Yeah.
The shutdown seems to be coming to an end.
Yeah,
I think it's just a normal vicissitudes of presidential popularity, probably.
Right. Okay, so finally, I frankly have been depressed the last couple of weeks because when I decided to stay out of the bubble, I bought bonds and I bought bond proxies. So you remember me talking about this. These are included a chunk of renewable real estate investment trusts, such as Foresight Environmental. And the idea was that the NAV had been falling because interest rates had been rising, leading to a higher discount rate on the future cash flows. So as interest rates fell, so the discount rate would fall, leading to a rising NAV. And also the discount versus the NAV had fallen risen as the NAV fell, and as the discount rate fell, NAV would rise and the discount would narrow. So I'd get sort of a double whammy. And I invested in all these basically thinking they were quite conservative bond proxies, but it hasn't turned out that way. The blue line at the bottom is the share price, which has been an absolute disaster. And it got a lot worse last week, because what happened last week is that the UK Department of Energy, and all of these have huge exposure to the UK, decided that it would try and rewrite the rules on indexation. So the renewable obligation certificates, which determine the price that these renewable energy REITs get for the electricity they generate, that was linked to RPI until 2030. Now they're talking about option one, bring forward the switch to RPI from RPI to CPI to 2026, or even worse, to basically freeze the payments at the current level until RPI catches up with CPI, until CPI catches up with RPI. Now, this is from Bluefield Solar, and they estimate under proposal 1 that the NAV would drop by about 2p, and under proposal 2, it would drop by 10%. So this is non-trivial. It's very essentially Labour attempting to rewrite these contracts, and it's been very bad for the share prices, and very bad for contract law, essentially trusting the UK government to fulfill its obligations. If just the very fact they've done this consultation shows their willingness to rewrite these contracts and will disincentivize future investment. Not great, very bad for me, and not something, frankly, I went into these without really thinking about them too hard, thinking, well, they've got a huge discount to NAV. How bad can it get? Well, it can get a lot worse if the government changes the rules. So essentially, it's been a total disaster. just as my bonds have started to recover, I've lost money on these. And essentially, every penny of income I've earned on all my REIT portfolio has been offset by the losses on these, the proportion which is renewable REITs. Now, they're yielding 10 to 12%. You know, Greencoat Wind is yielding 10.4% and has got 1.3 times dividend cover. So the dividend's not really the issue. It's future dividend growth and the NAV. Not great. But going forward, to return to our earlier conversation, I have been thinking about next time moving into oil and gas. And for the main portfolio, that means moving into ETFs. So what ETFs are available on the London market? Actually, not that many. So the big ones are SPOG, which is the iShares Oil and Gas Exploration and Production ETF, expense ratio of 0.55%, assets under management, not great, actually, not huge, 228 million. And when we look at its holdings, they're not what I would have expected. The biggest holding, Canadian Natural Resources, you know, where's Exxon? Where's BP? This is very much exploration and production. I don't think if you wanted to hold a portfolio of oil and gas companies that, you know, Canadian Natural Resources would be your number one buy, and it's mainly US. Another one is Van Eck Oil Services, assets under management 29 million, not big enough. Basically, that's going to be hugely illiquid. I personally would avoid this. Halliburton is that these holdings are sensible, but it's just too small. Getting in and out of that is going to be difficult. So I'm going to buy WENS, which is iShares World Energy Sector. Notice it doesn't mention oil in the title at all, and therefore, if you're just searching around for an oil ETF, you might miss this. It's big, it's got 1.6 billion under management, and when you look at its holdings, they're what you would hope they would be. Exxon number one, Chevron, Shell, etc. This looks like what you should be buying, or what I should be buying if you want long-term exposure to oil. So when you look at its holdings by sector, 55% integrated oil and gas, exploration 17%, etc., etc., coal 1.4. So I will be mainly buying WENS. I'll also buy some SPOG. The other one is the iShares Stock 600 Oil and Gas ETF, which has holdings on oil companies which are listed in Europe, but its primary listing is in Germany, its secondary listing is in London, and I would suggest that it's very difficult to trade because it's only a secondary listing in Europe, but its holdings are perfectly sensible. So bottom line, there are only a few London-listed oil ETFs, and of those, the best appear to be WENS and SPOG. Richard, anything from you?
So, as I think most viewers know, I'm of the view that we are at the beginning of what people call a commodity super cycle. Commodities are distinctly undervalued if you measure them against time, if you measure them against gold, in fact, and also if you measure them against future demand from the move away from fossil fuels, which we should be doing to look after the planet, and particularly moving away from fossil fuels. There are many commodities which the demand for which is going to rise massively, and obviously there will be some substitution, but also there's the demand will rise so much, the price will go up. As we sort of discussed briefly a bit earlier, if the cost of energy goes up, then the cost of extraction goes up, which means the margins of these companies doesn't necessarily go up, or you have to be careful that you don't hold them as their margins begin to contract. My overall investment strategy at the moment is to diversify into other commodities, particularly those that are going to be useful for the energy transition, and particularly energy commodities, i.e. oil and coal.
Great. Okay, well, I will be buying some small oil and gas companies in the coming weeks, and I will let you know what I buy.
Yeah.
Actually, the first one I'm going to buy is Petrotal. So Petrotal has it's got a dividend yield of 12 to 13%. It is cash positive, and it's got production assets in Peru and good reserves. And basically, oil price go down, it won't go bust.
I like the dividend, Keith. Sounds great.
Yeah. Okay. So that's it for this week. Long episode. Thank you, Richard. Hope your back improves.
Thank you.
And
Sorry for fidgeting.
yeah. And so please can you press like and subscribe to the channel? And we'll be back in 2 weeks' time. Good luck. In the meantime, it's goodbye from Richard Wheaton.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.